People looking to invest in the stock market, especially as first-timers and sometimes as repeat investors, often have one question in common. This simple and pretty much harmless question is it too late to start playing in the stock market? Answering this question in truth requires first acknowledging just how complicated trading in the stock market can be, as well as the extent of diligence and sacrifice that is required to build an investment portfolio that is just as rewarding as it is bulletproof. If you're looking to build a foundationally strong portfolio for 2022, then this video is for you. What we've detailed in this video would help you build your wealth and a long sustainable investment portfolio, starting right now. If you're focused on long-term investment and not just in the market to speculate, then it would be sacrilegious not to watch this video till the very end. But one thing that'll be more sacrilegious than that is if you fail to give this video a like or subscribe to this channel. Done those? Great. Now let's get right into it. Investing in the stock market necessarily requires that you have to be prepared for a whole lot of eventualities. You have to be prepared for every curveball in the investment cycle and every potential crash. Heading into 2022, stock market indexes were pretty much on the high side, and this posed an additional challenge to new and seasoned investors alike who feared the stakes were rather too high. If you haven't gotten into the stock market yet and you want to learn how to structure your portfolio in ways that mitigate risks and allow you to maximize your returns without leaving any money left unutilized, then you should pay close attention to the details we'll be dishing out in this video. Building a conservative and long-time investment portfolio that captures requisite upsides and still builds your wealth requires considering quite a several factors. For context, if you're an investor who's just looking to put your money in the market without having to worry about its daily swings and pretty much do nothing while earning from the stock market, the best option available to you would be to invest in an index, specifically exchange-traded funds. For investors, an index is a measure of the performance of the price of stocks, bonds, and other tradable assets in the stock market, and tracks a market index such as the S&P 500 or the Nasdaq 100. Index funds use a passive investment strategy and objectively deliver returns similar to an index of investments. The returns on index funds are, however, usually slightly lower than that of the actual index due to the fees associated with them. So this is a very good strategy if, as an investor, you're merely looking to capture the returns of the market using passively managed ETFs. With index funds, you could build a diversified investment portfolio and earn solid returns on your investment, as index funds typically don't try to beat the market or earn higher returns when compared with market averages. Instead, they try to mirror the performance of the market as a whole. To put this into perspective, popular index funds like VU return about 15% in 2021 alone, and an average of 17.6% in the past 5 years. Index funds are great in helping you balance the risks in your investment portfolio as an investor. This is because market swings are less volatile across an index compared with individual stocks. ETF strategies are generally great for beginners or advanced investors who are looking to play it safe or do not have the time to follow the market trends. The most crucial advantage with ETFs is that as long as you have enough money to spare and put into them, you begin to constantly get returns as much as 8% to 15% whilst doing nothing. And this is no doubt a great option for most investors who have no interest in being active in the market after their investment. For this video, we'll be dwelling largely on index funds, especially ETFs, and getting into more details on the diverse benefits of ETFs as a stable and hassle-free investment strategy, particularly for beginners who are still testing it out in the murky waters of stock investment. As a new entrant into the stock market, index funds are a great class of investment to help you balance the risks in your investment portfolio as an investor. This is because market swings are less volatile across an index compared with individual stocks. Investing in an index or ETF is essential to having a bulletproof and rock-solid investment portfolio. Here are a few key points that would give you a wholesome understanding of what index funds are and how they work. Index funds are an indirect way to buy the whole market by buying the securities that make up the whole index. An index fund enables you to buy shares indirectly from every company listed on the index. By enabling you indirectly buy shares from every company listed on the index funds gives you a higher chance of earning market gains, as against trying to beat and outperform the market. Ironically, you are practically winning by accepting defeat. Index funds are available across a variety of asset classes and are increasingly becoming popular among investors, especially as people are now paying greater attention to passive investing. You can buy funds from companies based on their capital valuation, either small, medium, or large, or you can focus on the sector in which they are operating, such as energy, technology, etc. So what do you stand to gain from investing in index funds? One fact is, while individual stocks may rise and fall and remain typically volatile, indexes tend to rise over time. With index funds, however, you won't get bullish returns, but you also wouldn't lose cash to a single sinking investment. For context, the S&P 500 has posted an average annual return of nearly 10% since 1928. That's nearly a century. Index funds also have fewer fees, and you don't have to worry about your returns being eroded by expense ratios, which are the ongoing costs associated with investing in a fund. Especially as you're not paying anyone to help you study financial statements and make calls on what you buy. The low cost of passively managed index funds always makes a difference and remains a core reason why index funds often outperform actively managed funds over a long period. Index funds also remain a vital tool for diligently diversifying investment portfolios, helping you spread investment risks around as an investor and allowing you to have a better choice around conservative and riskier investments, as well as a broader mix of industries and asset classes. Index funds are, and if you can't beat them, then join them approach for investors, allowing you to easily and efficiently track market indices. Although investment strategies can be deeply complex, index funds are very easy to understand, given though what you see is what you get quality that is embedded in them. Aside from investing in index funds or ETFs, it's also crucial to ensure that your portfolio is diligently allocated. It's ideal to have liquid cash as a component of your portfolio. Having liquid cash enables you to take quick advantage of great opportunities as they arise in the stock market. Advisably, a 10 to 15% cash ratio in the portfolio is ideal. You might also choose to leave out having cash in your portfolio, and that'll be just fine as well. A popular investment strategy in the stock market is to be aggressive with a few great stocks, but to be conservative throughout. Long-term-minded portfolios should especially be very conservative and well-balanced. A rock-solid and impenetrable portfolio would also contain a substantial amount of blue-chip stocks. These are stocks from the biggest technology companies like Google, IBM, Amazon, and the likes, and are great for a balanced and long-term portfolio. These stocks are largely stable over a long time, as they are super large capitalization stocks. Blue chip stocks have a great reputation, are highly dependable, and might even pay a dividend. As a new investor, your preference should be investing in stocks that have a market capitalization of $100 billion or more, as this would necessarily imply that these stocks are not relatively new stocks with zero to very little earnings. Also, be sure to look at other metrics and do not just base your investment on the market cap alone, as some companies might have a decent market cap of close to $100 billion but still have very little earnings. Companies like American Express, Citigroup, Target, and HSBC are some great 100 billion companies that can be invested in. In essence, diligently look into these companies and make sure they're highly profitable, have healthy balance sheets, and their management teams are top-notch. Blue chip allocations should take up the largest chunk of your portfolio if you're looking to bolster your earnings. We'll be making several videos on fundamental analysis of different companies and how to pick great stocks, so make sure to subscribe to the channel for that. With 25% of your portfolio in ETFs, 35% in blue chips, and another 10% in liquid and investable cash, that'll be 70% of your portfolio is in very safe and stable investments for the long term. With the remaining 30%, you could play around with stocks with greater upsides that have the potential to produce outsized returns for our portfolio in the long run. With the blue chip stocks and ETFs already in the portfolio and largely preserving your capital, you can afford to try your hands at a bunch of upside stocks as well. Additionally, you should be sure about your risk tolerance, which measures your ability to accept and cope with investment losses as a trade-off for earning higher investment returns. As a stock investor, you should construct and align your portfolios to investment strategies by following a systematic approach and making adjustments when necessary, by deciding which underweight securities to buy with the proceeds from selling overweight securities. You should also constantly monitor the diversification of your portfolio to see how weightings change over time in guiding your decisions. A well-diversified portfolio is vital to any investor's success. As an individual investor, you need to know how to assess your asset allocation in a manner that best conforms to your personal investment goals and risk tolerance. In other words, your portfolio should meet your future capital requirements and give you peace of mind while doing so.